Historically, every 8 to 15 years or so, we poke the global economy with a stick. And eventually, it breaks in spectacular fashion. We like to think that financial crashes are unpredictable, right? That they happen out of nowhere. That they're caused by some one-time event nobody could ever see coming. But if you zoom out, the same crisis has already happened again and again. So in this video, we're walking through 5 of the biggest financial meltdowns in modern history. What triggered them, how they unfolded, and what they all have in common. Because history doesn't repeat itself exactly, it just keeps getting more expensive. Welcome to Alux, the place where future billionaires come to get inspired. When debt outruns productivity, the 2008 financial meltdown. So in the years leading up to 2008, nothing really felt that dangerous. The economy was growing, unemployment was low, banks seemed stable. Owning a home felt like the safest thing you could do. Buying property was seen as a guaranteed way to build wealth. And people trusted the system that made it all so easy. It was all very ordinary on the surface. But behind that calm, the entire system was pushing risk further and further out of view. Banks had changed how they made money. So instead of holding on to mortgages and collecting payments over time, they started bundling those mortgages into financial products they could sell immediately. These were called mortgage-backed securities. So just imagine thousands of mortgage contracts dropped into a blender. The result is a jar full of debt sliced into layers and sold off to investors. The top layer gets paid first, so it's safer. The bottom layer gets paid last, but earns more. So as long as homeowners paid their mortgages, the system worked okay. So banks rushed to create more mortgages, even if they had to give loans to people with no income or savings. But they didn't care if the first borrower couldn't afford the loan, because the moment the paperwork was signed, the risk was passed on to somebody else. And everything worked fine until those housing prices stopped going up. You see, a lot of people weren't actually paying their mortgages out of their own income. They were counting on their homes going up in value. So when they needed money, they would just refinance, meaning they would borrow more against the new, higher value of the home. But in 2006, that stopped working. Prices didn't go up anymore. In some places, they started going down. Imagine you bought a house for $400,000 and now it's only worth $350,000, but you still owe $390,000 on it. You're stuck. You can't refinance, you can't sell, so you just stop paying. And you weren't the only one. Millions of people were in the same boat. That is when the chain reaction started. The mortgage-backed securities, those jars full of monthly home payments that investors bought, they started to dry up. Less money was coming in, and remember, the riskiest investors got paid last. So when homeowners started defaulting, those bottom layers got wiped out. Then the middle layers cracked. Soon, even the top layers weren't safe anymore. And here's where it got even worse. Some big banks had sold insurance on these jars, a financial product called a credit default swap. It was like saying, don't worry, if the mortgage jar breaks, I'll pay you for the damage. Except they sold way too much of this insurance. And when the jars started breaking everywhere, they could not cover the damage. Investors panicked. No one knew who was safe anymore. Banks stopped lending to each other, people couldn't get loans, businesses couldn't make payroll. The entire money system froze. And that's when Lehman Brothers collapsed. That's when the government stepped in with trillions. And that is how a few bad home loans became a global financial crisis. Over 8 million Americans lost their homes. Stock markets around the world crashed, unemployment soared, and the global economy froze. Governments printed trillions of dollars, interest rates were slashed to zero, banks got bailed out, but families did not. For most people, the recovery took years. For some, it never came. This is what happens when debt grows faster than value. The system was designed to reward quantity over quality. The more loans given out, the more money made, even if the borrowers couldn't pay back. Every financial system starts with rules. Then we find loopholes. Then we build entire industries inside of those loopholes until the system collapses under its own weight. 2008 wasn't the first time that we mistook complexity for safety, and it certainly won't be the last either. And if you want to not only build your wealth, Aluxer, but secure it from financial crises, the lessons and tools available to you within the Alux app are incredibly valuable. We hire industry experts to break down all of the steps they take in their own lives, businesses, and careers, and they teach it all to you for less than it costs to eat a nice meal at a restaurant once a month. Hundreds of thousands of people are already using the Alux app to level up. We've even helped to mint a few new millionaires. Join them on the inside by downloading the Alux app and scanning this QR code, and you'll get 25% off the annual membership. And, well, that's enough self-promotion for today, all right? Let's carry on here and discuss when speculation replaces fundamentals. We're talking about the dot-com bubble next. So by the mid-1990s, the Cold War was over. America was the only global superpower. The economy was strong, inflation was low, and unemployment was falling. The internet was brand new with no one really understanding it yet. But everyone agreed it was going to change everything. And in a world that felt stable, people were willing to take risks. Investors had money to burn. Interest rates were falling, and the tech industry offered something the old economy didn't: the future. And that's where the money started flowing. So the logic was simple here. If the internet was going to be the next big thing, then every internet company would eventually be huge. Investors wanted to get in early, so they started funding companies based on potential, not performance. As long as you had a .com in your name and a big enough vision, someone would write you a check. Startups raised hundreds of millions and spent it fast, mostly on advertising, offices, and staff. They weren't profitable. Some didn't even have working products. But that didn't stop them from going public. Once they hit the stock market, regular people joined in. Everyone thought, well, if this is the next Amazon, I'll get rich too. Stock prices went up just because people believed they would. Suddenly, companies with no business model were worth billions. Investors were buying based on the story, not the numbers. And the media fed into this hype. A website selling dog food gets a Super Bowl commercial before it ever makes any money. That was Pets.com, and it raised $300 million before it collapsed. The bubble grew because everyone thought they could sell at a higher price before things fell apart. Nobody wanted to be the last one holding the bag. But eventually, people started asking some real questions. They looked at the numbers and saw the truth. Most of these companies were burning through money with no real path to survive. The moment confidence dropped, the selling began, and once the prices started falling, it turned into a stampede. People rushed to cash out. Companies that were worth billions one month were worthless the next. The entire tech sector collapsed. The Nasdaq, the index filled with tech stocks, fell nearly 80%. $5 trillion in market value disappeared. Tens of thousands of people lost jobs. Startups shut down, and investors who thought they were riding the future lost everything. Even strong companies like Amazon lost over 90% of their value. It would take years to recover. Every bubble starts the same way, okay? With a new idea and a new crowd that can't stop looking at it. But attention doesn't equal value. You can't pay your employees or investors with hype, okay? And every time we forget that, the crash comes right on schedule. Next up, when inflation becomes the hidden tax. We're talking about the oil crisis and stagflation. So by the early 1970s, the world had shifted, right? The US was no longer the only economic giant. Other countries, especially in the Middle East, had started to realize how much leverage they held, especially when it came to energy. Oil had become the world's most important resource, and America was using more of it than anyone else. At the same time, the US had just lifted the gold standard. That meant the dollar was no longer tied to anything fixed, and inflation was already picking up. The global economy was entering a new phase, more connected, more volatile, and more vulnerable to power moves. In 1973, the US supported Israel in a major war. In response, a group of oil-producing countries, OPEC, decided to cut off the supply of oil to the West. With one decision, the world's energy supply was squeezed overnight. Oil became 4 times more expensive in a matter of months. Gas prices soared, and the cost of everything else followed. Because you see, oil was baked into everything: shipping, manufacturing, transportation, food. So when oil prices went up, the cost of almost everything else followed. That is inflation. But normally when inflation happens, it means the economy is strong and people are spending more. But that's not what happened here. This time, prices were going up, but the economy was slowing down. Companies were cutting jobs, growth stalled, and yet the cost of living kept rising. This was something new here: stagflation, which is inflation plus stagnation. Central banks were stuck. If they raised interest rates to fight inflation, they would make the recession worse. If they kept the rates low, prices would keep on rising. They tried a little bit of both, but it didn't work. Confidence kept on falling, and people started to feel like there was no way out. By the end of the 1970s, the US economy had been dragged through nearly a decade of pain. Inflation hit double digits, unemployment stayed high. And $1 in 1970 could buy only half as much by 1980. Gas was being rationed. Wages were not keeping up. Retirees saw their savings lose value even if they had never touched the money. And there was no market crash to mark the pain. The only way out came in the early 1980s when the Fed raised interest rates to nearly 20% to stop inflation cold. It triggered another recession, but it finally worked. Now, this crisis wasn't caused by bad loans or the stock market hype. It was caused by supply shocks, bad policy, and over-dependence on one resource. And it proved to be something that we still forget today, okay? Inflation is not just about numbers, it is about trust. Once people lose faith in what their money can buy, fixing the problem becomes 10 times harder. This wasn't just economic pain, this was a loss of control. All right, next we're looking at when asset prices detach from reality. We're talking about the Japanese asset bubble. So, in Japanese culture, status is quiet and subtle, often tied to things like education, reputation, or ownership of something meaningful. By the 1980s, one of those things was land. Owning property in Tokyo was a symbol of success, and the more valuable it became, the more people wanted it. At the same time, Japan's economy was on fire. The country had rebuilt after World War II, launched a manufacturing boom, and was now producing the world's best electronics and cars. People started to believe it would soon be the richest country on Earth. So to keep the economy growing, Japan's central bank kept interest rates low. That made borrowing cheap, and a lot of that borrowed money started flowing into land and stocks. People were buying property because they believed somebody else would buy it for more later on. Sound familiar? So banks saw prices going up and assumed that meant the risk was low. So they kept on lending even when the numbers stopped making sense. At the peak of the bubble, the land under Tokyo's Imperial Palace was estimated to be worth more than all of the land in California. It felt like Japan was finally taking its rightful place at the top of the global economy. Real estate prices in Tokyo were going up so fast, people stopped asking what something was worth and just asked how much they could borrow to buy it. Companies were taking out loans, buying land, and then using that same land as collateral to borrow even more. Banks were filled with these inflated assets, and because nobody wanted to break the illusion, everything looked stable even though it wasn't. Then, in the early 1990s, the Bank of Japan raised interest rates to cool things down. Borrowing got more expensive and demand started to fall. Now, it didn't crash all at once, but the moment prices stopped rising, that cycle broke. People stopped buying, companies couldn't pay their debts, banks were left holding assets that were worth far less than they had thought. And nobody wanted to admit how bad it really was. The stock market collapsed, the real estate market deflated, but instead of fast cash, Japan entered a long, slow decline. A home bought in Tokyo in 1991 was still worth less than its purchase price 15 years later. The 1990s became known as the lost decade, but that stagnation dragged on well into the 2000s. Wages flattened, spending slowed, young people stopped taking financial risks. Japan essentially froze in time economically for an entire decade. And you know, what makes the Japan crisis so interesting is that technically it wasn't even supposed to happen. Japan was doing everything right. Real growth, real exports, real innovation. Their economy was built on actual progress. At the time, everything worth having seemed to come out of Japan. 80s Japan was literally how the future was supposed to look like. But then, they pulled a classic DJ Khaled. They suffered from success, and in the most poetic way possible, they walked themselves straight into a bubble. And finally, we gotta talk about when trust in the system collapses. That was the Great Depression. Now, in the 1920s, America was full of confidence. The war was over, at least the first one. Industry was booming, cities were growing fast, cars were everywhere, and technology was changing daily life. People believed the country had entered a new era, one where prosperity was permanent. Newspapers called it the Roaring Twenties. Jazz clubs were packed, radios were in every home, and everyone from business owners to barbers wanted a piece of the stock market. Most people had never owned stocks before, and now they could, thanks to easy credit. All they had to do was borrow some money, buy some shares, and wait for the price to go up. And that's exactly what they did. Stock prices kept rising, and people thought it would never end. Banks were lending to anyone who wanted to invest, and because prices were climbing so fast, people were borrowing more and more. The problem was, they were buying stocks with money they didn't have. That's something called buying on margin, basically borrowing the money to invest more than you can afford. Something the folks over at our Wall Street Bets know a little bit too much about. So, if the stock went up, they made big profits, but if it went down, they still owed that loan. At first, it worked. Everyone seemed to be getting rich, but underneath, the prices had gotten far ahead of reality. Most companies weren't earning enough to justify their stock prices. The system was full of debt. In October 1929, some large investors quietly started to sell. That made others nervous. More people sold. Prices started falling, and the confidence that had held a whole system together began to unravel. Because so many people had borrowed to buy stocks, falling prices triggered panic. Investors couldn't cover their loans, so they were forced to sell, which pushed prices down even more. It wasn't just individuals. Banks were invested too, some with their customers' money. When the market fell, they lost everything. And once banks started failing, people rushed to pull out their savings. But the banks didn't have the cash. Thousands of them collapsed. There was no deposit insurance. If your bank failed, your money was gone. The economy simply stopped. Unemployment in the US reached 25%. Factories shut down, trade collapsed. People who had once been middle class were now standing in bread lines. The crash spread globally. Europe was already unstable, and the Depression made it worse. It pushed countries toward nationalism, protectionism, and eventually war. It took over a decade and a world war to rebuild confidence in this system. Now, every economy runs on credit and trust. People trusted the market. They trusted the banks. They trusted that the system would keep on working, but none of it was built to handle fear. And once that fear spread, nothing could stop it. The Great Depression wasn't caused by one bad policy or one greedy group. It happened because everyone believed the party could go on forever and nobody had a plan for when it didn't. Every one of these crashes looks different on the surface, right? Some were fast, others took years to unfold. Some were caused by too much debt, others by inflation, bubbles, or political shocks. But each of these crashes happened because the system kept pushing further than it should have. Too much leverage, too much trust in bad models, too much money chasing shortcuts. And we're seeing some of those same signs again. Asset prices are rising faster than earnings. Debt levels are at all-time highs. Speculation is back. Meme stocks, overhyped tech, record credit and credit card debt. And underneath it all, a belief that this time it'll be different. But we might just be entering into that find out phase. Thanks for spending some time with us today, Aluxer. We hope you found this valuable. We'll see you next time. Until then, take care.